Well, good afternoon. It's great to be back in Minot. By the way, I didn't know it was called the Magic City, so I've already learned something, but I spent this morning at the Air Force Base, which was a lot of fun, which I've not been to before. Thank you for hosting us here. It's great to be with you. Great to have Brenda here as our moderator. I thought before we dive into Q&A, and Brenda has some questions, and I want to hear from all of you as well, I would start by telling you a little bit about the Minneapolis Fed, the Federal Reserve, and why I'm here. And why town halls like this are so important to me. So the Federal Reserve is our nation's central bank. We were created by Congress in 1913. Think of it this way, to manage the ups and downs of the US economy. In 1913, Congress did something unique, is they wanted all the different regions of the country directly represented in that policy process. If you actually go back in American history, it was many of our farmers in the 1800s couldn't get access to the credit that they needed to be able to finance planting their crops. And that created great hardship. And so to make sure that the different regions were part of this monetary process, that's why Congress created 12 independent Federal Reserve banks, the ninth of which is the Federal Reserve Bank of Minneapolis. Sorry, I'm getting some feedback. I don't know if we can turn the volume down ever so slightly. The ninth of which is the Minneapolis Fed. And the district that we are charged to represent is Minnesota, North and South Dakota, Montana, the Upper Peninsula of Michigan, you turn it the wrong way, and northwestern Wisconsin. And so a big part of our jobs are to reach out across this region to understand what's happening in our local economy. And then I go back to Washington, D.C. every 6 weeks, where we have what's called FOMC meetings, Federal Open Market Committee meetings. And part of what I'm doing in those meetings is I'm sharing with my colleagues in Washington what's happening in our regional economy. So visits like this today to Minot and meetings like this are really important to help me and my colleagues get a sense of what's happening here on the ground in the local economy. Now, each of the 12 Federal Reserve banks has a board of directors. So Brenda is on our board of directors, one of the bankers on our board of directors, and part of Brenda's job on that board, part of it's to oversee me and to oversee the bank, but also part of it is to represent all of you and to bring the perspective of what's happening in North Dakota, what's happening in the banking sector, what she's seeing amongst her clients and partners, bring that information to us. So we get information from Brenda and our other board members. We get information from outreach visits like we're doing here today. And we also issue surveys. You might get a survey from the Minneapolis Fed asking what's happening in your part of North Dakota or in your sector of the economy. All of this helps us make sense of the data that we're seeing. You know, we look at a lot of data on the US economy, and a lot of times those data are sending us mixed signals, but we have to make a decision. So how do we make sense of the mixed signals that we're seeing? A lot of the anecdotes that we hear from folks like yourself, business leaders, civic leaders, labor leaders, help us get a sense of where the US economy is going. And so I wanted to just share that with you, why I'm here today, why I'm eager to have this conversation, both to answer your questions, but also to hear from you what's happening here in the economy on the ground. That's going to make me and my colleagues smarter as we think about the path ahead for the US economy. So with that, Brenda, over to you.
Well, thank you, Neel. And again, we are so excited to have you here, because I brag about all of you all the time, so he's here to check up on me. But happy to be able to ask some questions, give the audience a chance to ask their questions, because in the environment that we're in today, as you can imagine, there are a lot of questions, in particular around interest rates. And so I'll start with a couple questions, we'll open it up, and so be sure if there's anything that you ever wanted to know, ask the hard questions. Neel's here to answer that for you. So the Federal Reserve has a policy to strive for an average 2% inflation rate over time. Can you explain this, and how do you think about that target?
Yeah, so most central banks around the world have adopted 2% as their inflation target. So first people ask is, well, why isn't it zero? Why do you want any inflation? And the way I'll answer it is this. You know, before the pandemic hit, we were struggling to get above around 1.5% inflation. We said 2% is our target. We were at 1.5% roughly year after year after year. Well, one thing to note is that deflation, which is falling prices, is very problematic for the economy. Think of it this way. You take out a mortgage. Let's say your mortgage is X, you put 20% down, 80% mortgage. If your home price is dropping, your equity is getting wiped out and your mortgage is getting bigger and bigger and bigger relative to that asset. So deflation is a very bad thing for the economy as a whole. We have to avoid deflation. So what we said is we need a little margin for error. So that's why most central banks have said, 2% is a very low inflation rate. It feels like zero. It's a little bit above zero, but it gives us a little bit of margin if we don't quite get it right. And we weren't quite getting it right in 2015, 2016, 2017, 2018. So think about a very low inflation rate, but one that's slightly above zero. And that's what we're trying to achieve with our monetary policy. And obviously, we haven't done a very good job of that over the last few years, but the good news is inflation is headed down, though it's not all the way back down to 2% yet.
Thank you. In addition to inflation, the Fed does care about maximum employment. How do you think about that target?
So Congress has created the Federal Reserve, and Congress has given us our goals that we are trying to achieve. One of which is stable prices, what we defined as 2% inflation. The other is maximum employment. Think of as many Americans as possible gainfully employed and contributing to our economy. So what is maximum employment? How do you know when you're there? We're not exactly sure when we're there. So going into the pandemic, at first when we saw the unemployment rate nationally got to around 4.5%, most of us said, hey, it feels pretty good, like we're at a full employment economy. Businesses are struggling to find workers. The economy got stronger, the unemployment rate fell to 4%. Then it fell to 3.5%, and we still didn't have high inflation. So for me, maximum employment is when we're back at our 2% inflation target, when the economy basically is running at steady state, it'll be the unemployment rate associated with that. So we got down to 3.5% unemployment before the pandemic without high inflation, frankly with 1.5% inflation. I don't see why we couldn't get back to something that looks like that. In the short run, it might be a little bit different, but basically as many Americans as possible who want to work are able to find a job and contribute to our economy. That's what I want to try to achieve.
Thank you. We've seen a big uptick recently in the 10-year Treasury yields. What do you make of this increase, and what do you think are the implications, if any, for monetary policy?
It's a great question, and it's a very complicated question. And what we raise, when we want to slow the economy down, we will raise what's called the federal funds rate, which is an overnight interest rate that banks charge each other. Now, why do you care about an overnight interest rate? The answer is you really shouldn't care because it doesn't directly affect your life. But what it does do, moving these overnight interest rates up, it has an effect on longer-term interest rates, which you do care about. So typically when the Federal Reserve will raise interest rates, that will translate into higher mortgage costs. Let's say for a 10-year mortgage or 20-year mortgage or a 30-year mortgage. And that is a way to tap the brakes on the housing market because it ends up becoming more expensive for folks to buy a home. Or if you go out to get a loan to buy a car, you might take out a 5-year car loan. If the Federal Reserve raises the overnight interest rate on banks, that will generally translate into an increase in the cost that you would pay if you go to a bank to get a 5-year loan to buy a car. So you're right, the 10-year Treasury yields have gone up quite a bit. It's a little bit perplexing what is driving them to go up as much as they have in recent months. The Federal Reserve raised interest rates. We raised interest rates very aggressively last year, and we've really slowed the pace down in recent months. We raised once, we took a meeting off, we raised another. And so why are Treasury yields climbing now? It's a little bit hard to know. One story that we're looking at is there may be more optimism that there's more economic growth in the U.S. economy for the next 5 years or next 10 years. If it's a higher growth economy, that's a good news story that would cause interest rates to go up. Another possible explanation is people think that the Federal Reserve will be more aggressive over the next 10 years to try to bring inflation down. It's possible. Generally, Federal Reserve policy works in, say, 2 or 3 years ahead. It's hard to see that would translate to me into 10-year yields being up as much as they are. So it's a little bit of a head scratcher. Another possible scenario is the federal government is issuing a lot of debt for their various spending programs. Is it possible that is having some effect on Treasury yields? One place, and I'm getting very technical very quickly, it's just a complicated question. Traditionally, you would think that if the federal government is issuing a lot of debt, that would show up in high inflation expectations 10 years in the future. So we're seeing higher Treasury yields, but we're not seeing high inflation expectations out 10 years. So it's that combination of factors that's a little bit puzzling right now to understand what is the actual signal it's sending us. And that's an example right now of we're getting mixed signals from the data and we're trying to make sense of it.
So the bankers in the room, I've set you up for questions now. So it's time to look to the audience to ask a couple questions.
And we have microphones, so please, and just so you know, full disclosure, we're live streaming this, so please, fire away your questions. Do us a favor and introduce yourself so that the world knows who's asking the question. So maybe we got to bring a mic to you, sir. Hold on for a second. A microphone is coming to you.
Oh, you're going to hold it? Okay. I was just curious, during COVID, where the government spent a lot of money, trillions, in economic relief for the citizens. I was curious, with the dramatic actions that they were taking, was there any action by the Federal Reserve to lower Federal Reserve requirements for banks? And what is that at right now? And with the bank failures over in California, Silicon banks in Silicon Valley, was that any result of potentially of a lowering of reserve requirements?
The Silicon Valley Bank, I'll give a very simple explanation for what happened that caused Silicon Valley Bank to fail. You're right, the federal government put out a lot of money into the economy in response to COVID. If you got a check from the government, that money had to go somewhere. Generally, you went to your bank. So if you go to your bank and you deposit money in your bank, the bank then has to turn around and do something with that money. Now, traditionally, the role of banks is they would turn around and make loans. So let's say that a bunch of people would deposit their paychecks in or their stimulus checks in. The bank would then turn around and make a home loan to another family. Well, so many deposits hit the banking sector in 2020, 2021, that for some banks, it was hard for them to put that money to work, so to speak, in a safe place. They couldn't turn around and make new mortgages with it fast enough. So some banks parked that money at the Federal Reserve and earned interest on those reserves. Other banks said, no, I'm going to go buy long-term treasury bonds and mortgage-backed securities so I could earn a higher rate of interest on those holdings. That's what Silicon Valley Bank did. So Silicon Valley Bank got a flood of deposits in from their tech customers and their tech customers' employees, and then they turned around and made long-term investments in long-term mortgages with those. But then when the Federal Reserve raised interest rates quickly, the value of those mortgage bonds and those treasury bonds that they owned fell dramatically, and that scared people that said, hey, they may not have enough money to pay me back. And so that ended up triggering a run on Silicon Valley Bank. So that really was about the choices that that bank made on where they chose to put the deposits that they were getting in. They decided to put them in long-term bonds rather than putting them at the Federal Reserve in quote-unquote reserves, as you indicated. So that was they're not the only bank that did it, but they did more of it and an unhedged bet, essentially, that they were making than anybody else. Thank you for asking it. Oh, 1 second.
Hello.
Hi.
Hi, Neel. Trey Wellstead here. My question is, over the past 15 years, the Fed's balance sheet and the M1 money supply have risen exponentially. And I was curious your thoughts, if you think we're going to rebase at these higher levels, or if it's possible to go down towards the trend line without being too deflationary. And if we are rebasing, what do you think the future effect on inflation will be?
Well, so part of the answer of why the Federal Reserve's balance sheet has increased so much is because we changed how we implement monetary policy. Before the 2008 financial crisis, we were in one type of implementation regime. We've switched it to give us better interest rate control, essentially, but we need a slightly bigger, actually a meaningfully bigger balance sheet in order to implement it. And then at different times with quantitative easing, we've expanded the balance sheet even more. But we did, before COVID, we had shrunk the balance sheet down to a more of a normal level. And then COVID hit, and then we started doing QE again to provide more support to the US economy. And now we are running off that balance sheet again. One thing that drives the size of the Federal Reserve's balance sheet is simply the demand for dollars all around the world. The dollar remains the world's reserve currency. The demand for dollars continues to grow all around the world. And the Federal Reserve, with the Treasury Department, essentially prints those dollars to meet global demand for our reserve currency. And that means that the Federal Reserve's balance sheet is going to continue to grow. So I'm optimistic that we can continue to shrink it from our emergency maneuvers that we did back down to the trend line that you talked about. But that trend line is one of growth because there remains a lot of demand for dollars all around the world. And that's a good thing. It's a good thing that investors and consumers all around the world have confidence in the US economy and ultimately have confidence in the dollar. Thanks for asking it. There was a question up here in the front. Joe, right in front of you.
Hold it. Hi, Danielle Foster. Full disclosure, I am related to the moderator here today. She did not ask me to prepare any questions, however. But my question, and keeping in mind the Federal Reserve's goals that you have already touched on, and keeping inflation low and employment rates high, we've heard a lot in the news lately about a soft landing, and that's one of the Federal Reserve's focuses. Could you maybe touch on what exactly this term of art soft landing means to the Federal Reserve, and perhaps any risk factors you guys are taking into consideration that maybe you wouldn't meet that soft landing goal?
Yeah, thanks for the question, and great to see you. Traditionally, when central banks raise interest rates, especially if they raise them quickly, it can often lead to a rapid downturn in the economy. It could lead to a recession. There have been a lot of recessions in the world and a lot of recessions in American history, some of which are caused by the Federal Reserve raising interest rates to try to cool down the economy. One of the big surprises, positive surprises for me in the past year, is that we've raised interest rates aggressively and the economy has remained remarkably resilient, more resilient than I would have guessed. And the job market has remained remarkably resilient, more resilient than I would have guessed. So on one hand, so for example, the unemployment rate got down to as low as 3.5% nationally. It's now ticked up to 3.5% to 3.8%. That's still a very good labor market from a worker's perspective around the country. So on one hand, it looks like we seem like we're on track for a soft landing. Inflation has come down quite a bit. The labor market has remained strong. Maybe we can get inflation all the way back down and avoiding a deep recession. That's what I would call a soft landing. So far, it's looking more favorable. Now, having said that, there's another side of that coin. If inflation is still too high, and if inflation hasn't come all the way back down yet, might we have to do more with monetary policy? If the economy is more resilient than we understood, then we may have to step on the brakes harder. And if we have to step on the brakes harder, then maybe that means that we still don't get the soft landing that we're hoping for. So, so far things are looking hopeful, but it's too soon to declare victory.
You talked about the dollar being the currency of the world. There are many reports, or a number of reports in the press about both friendly nations and ones less friendly looking to try to create a monetary system that would supplant the dollar. What are your thoughts on that?
I don't want to say never. That's never possible. It certainly is possible. There have been other currencies that have been the global reserve currency throughout human history. But what sets that? What sets that standard? Ultimately, that standard is set by which major economy investors around the world have the most confidence in. So right now, we have lots of challenges, as we know, in our country. But I would not trade places with any other country in the world by miles. All right? We have a rule of law. It's not perfect, but it's pretty darn good. We have Capital markets, they're not perfect, but they're pretty darn good. We've got wonderful education institutions like we have here. We've got great innovation. We've got a great private sector, et cetera. And so what other economy is poised to challenge us? 5 years ago, 10 years ago, there was a ton of hype around China. China's uncontrollable growth, they're going to supplant us. The narrative has now totally changed, largely driven by their demographics. They adopted a one-child policy, so their demographics are cratering right now. Europe is the other possibility. They're big enough. They've got the scale. But they have, if we have challenges, they have many, many, many more challenges, especially given all the countries that they have, the different languages that they speak, the lack of fiscal integration. And so I don't want to say never, certainly never going to say never. Is it possible? But in the foreseeable future, it's hard to imagine any other major economy outcompeting USA Inc. And ultimately, whose reserve currency, it depends on who's got the strongest underlying economy. And that's where I think our competitive position is very strong. In the front, Joe, there's a gentleman with a question.
Hi, Richard Gleason. So,
Sorry.
hi there, Richard Gleason, thank you. So we have an inverted yield curve, and one thing that's weird is it's got that little bump around the 20-year mark where it kind of goes like this and like that. I don't know what you can comment on that, but my main thing is inverted yield curves, and I know you know, have been predictors of a recession for the last 10 recessions. And you seem to think we're kind of buzzing the tower or trying to go for a soft landing. Why is it will be different this time? I mean, you kind of got into it, but I'd like to get a little bit deeper.
Yeah, so the gentleman asked about the inverted yield curve. So let me start by explaining what that is. Maybe, not everybody's going to know what an inverted yield curve is. If you look at the rate that the U.S. government borrows from the public, they can borrow short term. They could borrow with 1 month time period. They could borrow for 1 year. They could borrow for 5 years, 10 years, 20 years, 30 years. And that forms a curve. Generally speaking, the longer the government borrows from the public, the higher the interest rate that they pay, because people say, hey, you're going to lock up my money for 5 years. I want to get compensated with a higher interest rate. So generally speaking, that yield curve goes up. But the gentleman said, when we started raising interest rates, essentially the front end of that curve, the Federal Reserve has a lot of control over by raising interest rates. But if the long end stays fixed, the yield curve can invert. And then that can be an indicator that, hey, maybe a slow economic growth is coming in the future, maybe even recession. It's very complicated, and we don't have I've heard lots of theories explaining when there's good signal and when there's not good signal. One factor was, historically, when the yield curve inverted, inflation expectations were fairly stable throughout that period. So the first thing that was different this time was that the real and nominal yield curves inverted at different times. So if you looked at inflation expectations a year or two ago, when inflation took off, inflation expectations soared for the first few years, but then fell precipitously. And the dynamic of what was happening under the 1 month inflation forecast, 1 year inflation, 2 years, and 10 years, that was driving some very different dynamics in the yield curve inversion. So you would then have to look at the real yield curve inversion. Now, they're both inverted right now, but they're uninverting. So Brenda asked me about the long end of the curve going up. There's a few different ways that the curve can uninvert. One way it can uninvert is if the Federal Reserve cuts interest rates because we think the economy is slowing dramatically. The other way the curve can uninvert is if the long end goes up, which again, if there's a good news story explaining that, that could actually be a good news story of the uninversion, which maybe makes the recession less likely. So I don't know how much illumination I'm providing, but I'm providing you some of the thinking that we go through as we're trying to figure out, is this telling us something real, or is this something that may be sending us a false signal? And I don't know. In the front, Joe, there's another question.
Mark Lyman with the Minot Chamber EDC. We work with a lot of small businesses and entrepreneurs, hundreds of them in our community. Many of them are very passionate about what they do, but not necessarily working on their business. If they've only got 5 minutes a day or 5 minutes a week to pay attention to some of the great data and the information and the trends that can come out of the Federal Reserve if you were in their shoes, what would you be paying attention to so that they can have the most success as businesses and as individuals and as entrepreneurs?
You know, there are a lot of Federal Reserve officials who communicate about what we're seeing in the economy. So if somebody was so inclined, they could go and read speeches and reports that the Federal Reserve puts out, but that's more than 5 minutes a day or 5 minutes a week. And if you're running your small business, I don't want to burden you by saying, go and read all the stuff that we put out. I would say the professional press corps that covers the Federal Reserve for major news organizations around the world are excellent. And they work very hard to understand what these issues are, what policymakers are trading off, what is the data that we're looking at. So if you read any of them, and I'm not going to name them by name because I'm going to forget some and then they're going to get offended, but if you read any of the major news outlets who cover the Fed on a day-to-day basis, you will get a very good sense of the types of things that we're looking at and what we're trying to achieve. And then you could supplement that if you want to and go and look at what the Fed chairman, for example, if he gives a speech, that's the first place I would start. What is the Fed chairman saying? But I think the press corps does a very good job boiling it down into the core ideas that their readers could benefit from. So over here, and then you can decide. Go ahead. This gentleman right here is in front of you.
Well, I think I'd be. My name's Matt Watney. I think I'd be remiss if I couldn't ask the question about. I can imagine what your position on cryptocurrencies is, but what about a Fed coin or something? You hear some talk about that. What's the Federal Reserve's plan for electronic currency in the future and a government-backed electronic currency?
Yeah. Usually when I'm on college campuses, I always get asked about Bitcoin. And whenever I hear the terms cryptocurrency, my one suggestion for you is whenever you hear the term cryptocurrency, replace it in your mind with the term magic beans, okay? It is possible that these magic beans will grow a giant beanstalk and lead you to gold. My daughter's 4.5, my son is 3. We watch all of the nursery rhymes and all of these stories, so I'm very well aware of what's at the top of the giant beanstalk. But there's no evidence that these magic beans do any of the things that the enthusiasts claim that they do. So let's set aside Bitcoin for a second. Let's talk about a Fed coin or some other kind of digital currency issued by the central bank. The first question is, what does this thing do that you can't already do today? So I could send anybody in this audience $5 right now if you have Venmo or PayPal. That's an instant digital payment. Now, how does that exist? Banks, private sector banks, have built this technology with IT companies on the back of the legacy infrastructure that the Federal Reserve and others run. So the question is, what is it that a Fed coin could do that Venmo can't do? And nobody can answer that question. Not have the fee. Have you ever tried to buy or sell a Bitcoin? The fees are astronomical. The spread is huge, as this gentleman just said. So what is it that it could do? Nobody can explain what it could actually do. So then they say, oh, but China is doing it. Therefore, we need to do it. Well, let me answer the question. What could China do with a Chinese digital currency that you couldn't do with Venmo? Number one, the government could monitor every one of your transactions. Government can't do that. If I send you $5 right now with Venmo, the Federal Reserve is not going to know it. But FedCoin, in theory, we could monitor that. We could, in theory, directly tax your account. You can't do that with Venmo or PayPal. And if we wanted to, we could implement negative interest rates in your account. You can't do that today with Venmo or PayPal. So I get why China is excited about this. I do not understand what is in this for the American people. And so the most basic question I would encourage any of you to ask when somebody talks about a digital currency, whether it's a central bank digital currency or some other digital currency, what problem in society is this actually solving? And usually from the enthusiasts, what I get is a bunch of happy talk. They'll say, well, maybe it'll lower fees, but there's no evidence that it'll lower fees. Maybe it'll reach people who are currently unbanked Is there any evidence of that? No. Lots of maybes, and that's why I call it magic beans. Maybe it'll grow a giant beanstalk, but as of yet, there's no evidence that it actually grows any kind of beanstalk, let alone a giant one. So, long answer to your question, but I have views on that.
Hi, Tim Mahalik here. A question regarding artificial intelligence and the impact on the financial markets. Does the Fed or the government see any need to legislate, regulate AI as we move forward? Because it's going to be a big play in my vision, my look into the future.
I'll just give you Neel's opinion. There are going to be a lot of opinions about this across various agencies, and certainly your elected officials will have their own views, and it'll be up to Congress to decide what they choose to regulate or not. Personally, I think the most consistent export from Silicon Valley is hype. And, I always ask people, 5 years ago, we were told that self-driving cars were literally right around the corner, and all the long-haul truck drivers in America were going to be out of work. 5 years later, we're not much closer to self-driving cars. Now, I'm not saying self-driving cars won't come. I believe that they will come. But a lot of these forecasts of doom and gloom are right around the corner, and all these jobs are going to be displaced. I have a very healthy dose of skepticism. Right now, it's so early in AI. Right now, it seems like the biggest risk of AI is just one of IP theft. Like if you look at these large language models, from what I understand, they have this huge database of information, and then they forecast what's the next likely word in this sentence. That doesn't sound like intelligence to me. It sounds like mimicking to me. So if it turns out that these AI algorithms, which are so brilliant, are just ripping off somebody else's content, then there's tremendous IP issues associated with protecting the people who created the content in the first place. So if I were to guess right now where regulation is needed, I would guess in IP protection, but I think it's not even the first inning of understanding where this technology could lead. And could there need to be robust regulations around it in the future? Certainly, but I don't know enough right now to speculate what that looks like. But I think my gut tells me, as with all things from Silicon Valley, it's further away than the hype is telling us right now. I always remind people of the Segway. It was supposed to revolutionize transportation. You can go to Washington, D.C., you can take a mall tour of all the monuments. You can get a Segway. It's not that they have no usefulness, but it hasn't quite revolutionized transportation the way the hype originally told us. Oh, go ahead, Joe.
Thanks, Neel. Brent Windiger, I'm the CFO for Minot State. Welcome to campus, by the way.
Thank you.
It's been on my mind a little bit as I've watched the higher for longer strategy that the Fed is implementing right now. What do you see that doing to the federal deficit over the next decade, and what implications do you think that'll have for inflation? And the reason I ask that is simply because, it seems like they can either take money away from other programs in order to pay the higher federal debt, or they can just deficit spend, which it seems like would increase the inflation rate, which would come back on you at some point. But I'm just curious your perspective on that.
Well, we don't set monetary policy to try to help or hinder the government's fiscal choices. This is the clear distinction between fiscal and monetary policy. Fiscal policy, which is how much the government wants to tax, who they want to tax, what activity they want to tax, and what they want to spend that money on, whether it's defense or education or healthcare, that's purely up to our elected officials through the legislative process, and that's Congress and the executive branch. Their deal is that they say, okay, we'll leave that to us, and you all can set monetary policy to try to achieve the dual mandate. So we actually don't think about what does this mean for the federal government. We know we have a goal that we have to try to achieve, which is maximum employment and 2% inflation, and we need to conduct monetary policy to achieve that. Now, if the government's fiscal trajectory changes, that'll be an input into our understanding of what's happening in the economy, and then that could change what our path is for interest rates. But when you hear people talk about higher for longer, that really is simply looking at where we are right now, what inflation is doing, what wages are doing, what the labor market is doing, and what do we think we need to do to get it to finish the job, get inflation all the way back down to 2%. Brenda, maybe back to you.
I see one more hand.
Oh.
Will you support an independent audit of the Federal Reserve?
An audit of the Federal Reserve? Yeah, we are audited every year. If you go to the federalreserve.gov website, you can see the audit report of our independent auditor every year. All of our accounts are audited, all of our financial transactions are there, full transparency for the world to see. Now, what people often mean when they say auditing the Federal Reserve, they say we want to look at how you make decisions around monetary policy. And that is one where we have a policy that our deliberations are confidential for 5 years. And after 5 years, there's a full transcript of all of our materials, all of our analysis, all of our deliberations. And the reason that we do that, and most central banks around the world do something similar, is to try to insulate us from near-term political pressures. Meaning, the view is that if there was people looking, well, what did Neel say today in this meeting, or what did he say tomorrow, that there would be more likely to be political influence on these decisions. One of the things that economies around the world have learned, if you keep monetary policy as far away from politics as possible, you're more likely to have better decision-making for the long-term health of the economy. And that's why there's this 5-year quiet period, so to speak, confidentiality period on our deliberations. But the audit is there. It's on federalreserve.gov's website for all to download and see.
Hello.
Hi.
Hi, Chris Lamori. I work alongside Brenda Foster. I have for 33 years, and just found out from Dr. Shirley I'm much younger than I thought. Your colleague, Lori Logan with the Dallas Fed, said that higher bond yields may leave less for the Fed to do on rates. Are you in agreement with that?
It's possible. The funny thing about economics and financial markets is financial markets, they try to be forward-looking, and they try to get signal from where they think the Federal Reserve is going in the future. So part of what they're doing is financial markets are responding to what they think we're going to do. And so if we look at what their changes, let's say, I'm making this up, let's say 10-year rates go up because they think the Federal Reserve is going to be more aggressive. Then you might say, well, great, then we don't need to be more aggressive. Well, once they figure that out, then they're no longer going to stay where they were. And so it's a feedback loop that's a little bit hard to say definitively one is leading to the other versus they're leading, they're all looking at the same set of data. So it's certainly possible that higher long-term yields may do some of the work for us in terms of bringing inflation back down. But if those higher long-term yields are higher because their expectations about what we're going to do has changed, then we might actually need to follow through in their expectations in order to maintain those yields. So it's a little bit circuitous, and it's hard for me to say definitively, hey, because they've moved, therefore we don't have to move. I don't know yet. And we need to look at the rest of the inflation data that we're going to get in. We need to look at the labor market data that we get in, look at the wage data that we get in, for me to get comfort that we've actually done enough.
Well, while you're all thinking about a couple more questions for Neel, describe for the audience, Neel, does every Federal Reserve president get to vote at the Federal Open Market Committee meetings?
So there are 7 governors of the Federal Reserve Board, they're all in Washington, D.C. They've been appointed by the President of the United States, and they serve for up to 14-year terms, and they're confirmed by the United States Senate. So some of the board members today were appointed by President Trump. Some of the board members today were appointed by President Biden. Then there are 12 Federal Reserve Bank presidents, and we are appointed by a local board of directors. And she's not here today, but a North Dakota, well-known person in North Dakota, leader, Kathy Nezitt, was on our board of directors and was one of the selection committee that selected me 8 years ago for my role. And the presidents rotate when we vote on monetary policy. So I'm a voter. I rotate with the Kansas City Fed president and San Francisco Fed president. So I'm voting this year, and then for 2 years I won't be voting, and then I'll be voting again. So I voted in 2020, I voted in 2017. It actually makes less of a difference than you might think, because we all go to each meeting, We all give our own outlook for what the economy is doing and what it's going to do in the future. We all give our recommendation for where we think interest rates should go. And then in the last 30 seconds of the meeting, when they read the names of who's voting, they read certain names and not others. But that way, why is it done this way? Is the framers, I guess, of the Federal Reserve were trying to find the right balance between having Washington having influence versus all of the regions having influence. The governors vote every time, and then 4 of the presidents are voting. And so the governors, in a sense, have a bigger sway than the regional banks do because we are rotating around when we're voting.
Thank you. The Minneapolis Fed has a history of thought leadership on the too big to fail problem, including your public stances on this issue. What lessons can we draw from the Silicon Valley Bank and other financial instability episodes earlier this spring?
You know, I've been very vocal with my colleagues at the Minneapolis Fed about the issue of too big to fail banks. I was at the front line in the 2008 crisis trying to stabilize the banking sector, and I saw how devastating when a big bank runs into trouble, it's like a nuclear reactor melting down. Governments will spend any amount of money to stabilize that reactor, not for the sake of the power company or their shareholders, but for the sake of society, because the costs of that meltdown are borne by everybody else. Same thing is true when a big bank gets into trouble. So I've been very vocal that we need stronger regulations of the biggest banks in America. Even though I have taken this position, and I've had this position now for a long time, even I was surprised that a bank, quote unquote, as small as Silicon Valley Bank, could be destabilizing for other banks in the country. Because when Silicon Valley Bank got into trouble, it made borrowers question, hey, is my money safe at this other bank that's of similar size? And you saw this dynamic happening where businesses were moving their money from mid-sized banks to the giant banks because they effectively knew the giant banks had the government standing behind them. So the too big to fail status of the giant banks created a systemic risk for everybody else because they have this preferred position in the banking sector. So the bottom line is we have more work to do in really making sure that our banking system is resilient. You know, community banks were generally much more resilient because they got such good relationships in many cases with their customers. Their customers weren't concerned. It was more the mid-sized banks that ran into stress this last episode. And so, you know, we need to actually do something about the too big to fail issue. So I think we got more work to do.
Thank you. I guess one of the biggest interesting factors as I joined the Federal Reserve Board, and as a banker, of course, I'm thinking of it from the regulatory perspective, but what I was very interested to learn is about your research and your economists that are probably the greatest in the world. Can you talk a little bit about your research department?
Sure. We have each of the 12 Federal Reserve banks has its own team of PhD economists helping to analyze the regional economy, the national economy, and the global economy. And they do research on where's the economy headed in the future, and how do we even analyze the economy headed in the future. So our research director is here, Andrea Raffo. He joined us about a year ago from the Board of Governors in Washington, D.C. He leads our team of PhD economists, helping me understand where the economy is going. And the Minneapolis Fed actually has this very proud research tradition where we've had multiple Nobel Prize winners actually on staff or affiliated with our bank because they've been doing very cutting-edge research for thinking about how do you even understand the economy. I'll give you an example of the kinds of questions we're trying to figure out. So what caused this high inflation that we've all experienced? Most of our economic models that we rely on to forecast the economy did not forecast the high inflation coming. So what caused it? Well, what caused it was a confluence of events of, first of all, when COVID hit, most of the services economy was shut down. You weren't really getting on planes, you weren't going to restaurants, you weren't going to hotels. People were cooped up at home. Couldn't spend money on services, so people were buying a lot of goods, equipment, bicycles, cars, whatever they needed. So there was a lot of pressure on the goods market. Then you also, at the same time, had a lot of fiscal stimulus go to into people's pockets. But again, they couldn't spend money on services. That money put more pressure on the goods economy. Then you also had, because of COVID, supply chains get disrupted. So now the ability to produce those goods was now impacted. And then you had Russia invading Ukraine, also affecting commodity markets, which go into many of those goods. So you had this confluence of events hammering the goods economy all at the same time, causing prices to skyrocket. That's an example, trying to disentangle those dynamics to understand what caused this run up in prices and how much of that is going to resolve itself. So how much of it is going to be when supply chains get sorted out, that'll do some help, that'll help us somewhat. When the services economy reopens, that'll help somewhat. When workers come back into the workforce, that'll help somewhat. So the kind of thing that researchers do is they help us, they're not perfect either, but they help us try to disentangle some of these very confusing signals to figure out where the economy is going.
So another question I guess I think about a lot, and our peers, we've been discussing it, all the stimulus money that was put into the economy, consumers, businesses. What is your thought about, has that money now been spent? Is it still sitting in accounts? What's your thought around that?
It's a great question. That was one of the things that we thought would help bring inflation down, is we thought that money would get spent down pretty quickly, and then essentially people would have to go back to work, which would help the supply side of the economy. I would hear from some bankers of large banks that said that, one bank in particular said this, their customers who used to, before the pandemic, on average had $1,000 in their account, at the height of the pandemic had $7,000 in their account. How did that happen? It happened, one, because they were forced to save, because they couldn't go out to restaurants and they couldn't get on airplanes, and because a lot of fiscal stimulus went out at the same time. Or for their more well-to-do customers, somebody who had $5,000 in their account, they would have $15,000. So a multiple of 3 instead of a multiple of 7. But these are big, big numbers. What the notion we talked about was excess savings. When would this trillions of dollars of excess savings get paid down, get spent, and then the economy would go back to normal? It's a very hard thing to know for sure. We talk to a lot of banks who say, yes, they're seeing, especially with their low-income customers, the excess money is being spent down. People are starting to turn to their credit cards, et cetera. But if you look higher up the income spectrum, it seems like they still have a lot of extra savings. And then you go back and there are revisions. Well, how much savings do people really have before? And maybe there's still excess savings. So it's a question mark, and it's a very important issue, but it's still a question mark in terms of how much extra is out there. And it's possible that people are just feeling more confident because they have more money in their checking account, and so they're spending more, and that's keeping the economy, kind of the flywheel turning.
Any other questions from the audience at this time?
Oh, we see one here. Somebody's texting him a question to ask me.
No, I wrote it down.
It's okay.
Mr. Kashkari, thank you for being here. My name's Jordan Nelson. Real quick, one of the things I've noticed going through this summer and into this fall is a lot of the releases of economic data that have been very strong and very good seem to kind of quietly be revised in months afterward, after the data was released initially. Talk a little, maybe, if you could, on how this can cause an issue for the Fed and its decision-making, and what you guys do to make sure that the data that you're using to make these very important decisions is actually the most accurate portrayal of the economy that we can have.
Yeah, thanks for your question. So you're right, there have been a lot of revisions on the data, but there always are. There are teams of professional economists that are non-political, work for government agencies. These are career staff who do their very best to try to survey the U.S. economy and measure all of these things so that people like the Federal Reserve and private sector participants can make the best decisions they can. But they do get updated over time, and there can be revisions, just as you indicated, over time, going back and adjusting GDP, for example, or adjusting job growth as another example. I think that the dynamics of the reopening of the economy has caused my senses, and I don't have exact numbers behind this, my senses that the data feels noisier than usual. One thing we know for sure is that, for example, the government will send out surveys to businesses and to households to collect data on, what people are working on, are they working, what kind of job do they have, what sector are they in, is their business growing, et cetera. The survey response rates have fallen a lot. And so if the survey response rates are lower, you would think the data is going to be a little bit less reliable than if the survey response rate is 50% instead of 80%, it's maybe a less reliable signal than if you were actually able to survey as many people as you had historically. So that's something that I think all of the statistical agencies are working on to try to get those response rates back up and to get the data as clean as we can get it. You're right, we do want the best data we can get. We do rely on government data, but we supplement that with private sector data as well. And then we supplement that with going out and meeting with people, saying, what are you seeing? What are you seeing in your businesses? What are you seeing in your communities? Does this resonate with what the official numbers are telling us? Or are people on the ground seeing something different to ultimately make the best judgment we can? I don't think, the big miss that we had is we didn't see high inflation coming, which, by the way, is a big miss for a central bank. And that's me too. I'm not throwing stones here. I was part of the miss. It's not because the data got revised and we used one set of data, and if we only had 3 months later data, we would have been better at forecasting this. It really was the dynamics of the pandemic, the shutdown, the reopening, were something that's unlike anything any of us have ever experienced. To me, that was the root of the miss. But we do pay attention to the data because it's important, just like you said. Thanks for your question.
I think we have time for one last question, and there's one right over here.
And not even a question, just wanted to say thank you for your comments on the central bank digital currency. I agree that the biggest change they would bring would be more government oversight and control. So it's very reassuring to hear from a Fed president that you have the same views and that you view it in that negative light. So thank you.
Thanks for your comment. I'll just say, by the way, nobody that I know of at the Federal Reserve is excited about that, about oversight and control and monitoring. That's why when I ask my colleagues, what is it this thing can do? Right now, nobody can tell me other than hoping that it solves some big problems in society, but so far there's no evidence that it does. So we certainly are not interested in trying to monitor people's transactions. I can see why China would do it, but that's not for America.
Just a couple closing questions for you, Neel. As you visited our Minot Air Force Base today, was there anything that you heard or saw that was surprising to you?
Well, I said this to the colonel, one of the colonels who gave us a tour. First of all, fabulous what they do there, extraordinary facilities, obviously great professional, men and women in our armed services. Grateful for them being there. I was surprised that the missiles were smaller than I thought. So, which the colonel was taken aback when I said that. And the reason is because I started out my career as an aerospace engineer working on satellites. And there are some satellites that are the size of a school bus. And if you want to launch a school bus into space, the rocket to launch a school bus into space is massive. And so, anyway, that was my frame of mind when I saw the missile. I'm like, wow, the missile's so small. But I meant no offense by it. So that was one surprise.
And as we look to the last quarter of this year and we're trying to start our budgeting process in all of our businesses, and we look to what's happening in Israel, et cetera, what are your thoughts on the future of the interest rate?
Well, the implications for these massive geopolitical events on our economy are very uncertain. The first mechanism by which geopolitical events, whether it's Russia invading Ukraine or the Hamas attack on Israel, the first mechanism that gets back to America is through commodity markets, through oil prices first and foremost, but through other commodity markets as well. We saw huge price moves when Russia invaded Ukraine. So far, much more muted moves around what's happened in Israel. And hopefully that the region, Israel, will be able to reestablish their security and establish peace quickly, which will be obviously better for them, also better for the global economy. But I don't have any better insight into where that conflict is going, other than this is one of many shocks that we have to pay attention to, that if it gets big enough, in addition to the human tragedy, could have implications for the U.S. economy. And so we absolutely have to monitor it.
Any last comments?
Just thank you. Thank you for all. I visit North Dakota at least once a year. I've been coming for the last 8 years, sometimes more than once a year. Always learn a lot. People are very friendly and hospitable. Really appreciate your hospitality. And thank you for turning out today and asking great questions. So I really appreciate it.
And thank you for the audience for joining us today. And thank you so much, Neel, for being here. We appreciate your time today.
Thank you very much.
Thank you.
Appreciate it.